The investment narrative surrounding Blue Owl is currently a battleground between those who view its high-margin, permanent capital model as a revolutionary structural moat and those who perceive its concentration in technology lending and its premium valuation as a vulnerability in a shifting macroeconomic regime. The early months of 2026 have introduced significant volatility, driven by an AI scare in the software debt markets and an unprecedented surge in redemption requests within non-traded business development companies. The bear case, the narrative of systematic fragility. The bearish thesis for Blue Owl focuses on the potential for a perfect storm of credit defaults, liquidity mismatches, and valuation contraction. Critics argue that the firm's rapid growth has come at the expense of disciplined underwriting, and its reliance on retail capital creates a significant redemption risk during market downturns. The software debt disruption theory. A primary concern for Blue Owl is its heavy concentration in software and technology lending. Approximately 20% of the private credit industry's loans are to software companies, and a growing consensus suggests that generative AI could disrupt the licensing models of these businesses. If AI allows customers to build in-house solutions or use cheaper AI-native alternatives, the enterprise value of legacy software firms could plummet, making their debt unserviceable.
This concern triggered a massive sell-off in February 2026, with Blue Owl shares plunging more than 36% over a 6-month period. While CEO Mark Lipschultz has insisted that the book is strong and that software borrowers are deeply woven into their customers' businesses, the market remains on a hair trigger for any signs of performance deterioration. The software IT sector has already seen loan prices fall to an average bid of 90.4, levels not seen since the mid-2025 volatility. The liquidity mismatch and the BDC exodus. The evergreen structure of Blue Owl's non-traded vehicles, designed to provide periodic liquidity to retail investors, is currently being tested. In an unprecedented event in early 2026, the Blue Owl Technology Income Corp saw redemption requests totaling 17% of net assets, worth $685 million. While fund managers have agreed to honor these requests, the surge highlights the vulnerability of these structures. The broader private credit market is also facing a default rate discrepancy. While headline default rates remain below 2%, the true default rate, including selective defaults and liability management exercises, is estimated to be closer to 5%. Furthermore, 40% of private credit borrowers are reportedly struggling with negative free cash flow. If redemptions continue to rise while underlying credit quality degrades, Blue Owl may face a liquidity crisis that could force it to halt withdrawals, leading to significant reputational damage.
Refinancing walls and interest rate sensitivity. Blue Owl's borrowers are facing a massive refinancing needs wall through 2028. Maturities for B- and below-rated borrowers are expected to peak at $215 billion in 2028. If interest rates remain somewhat elevated, with S&P Global Ratings forecasting only a 50 basis point cut in 2026, many of these highly leveraged borrowers may find it impossible to refinance at sustainable rates. The rising use of payment in kind, PIK, interest is a warning sign of this stress. Public BDCs now receive an average of 8% of their investment income via PIK, up from historical norms, suggesting that borrowers are increasingly unable to meet cash interest obligations. For OBDC, PIK interest income was reported at $31.55 million in Q4 2025, a figure that, while down year over year, still represents a significant portion of non-controlled investment income. Valuation premium versus industry realities. Blue Owl trades at a significant premium to its peers, a fact that bears argue is unsustainable. Its trailing PE ratio has hovered between 120x and 160x, compared to an industry median of approximately 20x. While the forward PE is more reasonable, approximately 13x, this assumes perfect execution and no significant credit shocks. A comparison of valuation multiples as of early 2026 reveals the following. Blue Owl, trailing PE ratio of 121.5x to 153.8x, forward PE ratio of 13.2x to 13.4x. Ares, trailing PE ratio of 63x to 63.2x, forward PE ratio of 23x. Blackstone, trailing PE ratio of 40x, forward PE ratio of 23x. Apollo, trailing PE ratio of 19x, forward PE ratio of 13x.
The discrepancy between Blue Owl's trailing and forward multiples indicates that the market is pricing in a massive acceleration in earnings. Any disappointment in capital deployment or a spike in non-accruals could lead to a rapid multiple compression, causing the stock to trade in line with more traditional asset managers. The bullish thesis for Blue Owl is predicated on the belief that the firm has built a pure-play asset management model that is structurally superior to its peers. This superiority is manifested in its fundraising velocity, its mastery of the private wealth channel, and its strategic alignment with the AI-driven infrastructure boom. Blue Owl has successfully cracked the retail code that has eluded many institutional managers. Its fundraising in the private wealth channel reached record levels in 2025, with total capital commitments for the year hitting $56 billion. Products like Blue Owl Real Estate Net Lease Trust, ORENT, have delivered net returns of approximately 11%, vastly outperforming the FTSE REIT Index's 2.3% return. The firm's ability to gather assets from individual investors and insurance companies provides a diversified and relatively sticky capital base. While institutional allocators may rebalance based on strict portfolio constraints, private wealth investors often seek income and stability, which Blue Owl's permanent capital vehicles are specifically designed to provide. The expansion of the Talon tax-aware platform further underscores the firm's commitment to providing sophisticated solutions tailored for the wealth management community.
The acquisition of IPI Partners is not merely an AUM play, it is a structural bet on the backbone of the digital economy. The global demand for data center capacity is projected to triple by 2030, rising from 60 GW to as much as 219 GW. Hyperscalers such as Google, Microsoft, and Amazon are projected to spend approximately $600 billion in capital expenditures in 2026 alone to support AI and cloud infrastructure. Blue Owl's role in this ecosystem is as a provider of specialized off-market real estate solutions. The firm's ability to combine land parcels and secure power in established markets like Northern Virginia, which has expanded in a spiderweb pattern, provides it with a moat that financial-only firms cannot replicate. The Digital Infrastructure Fund III's success in exceeding its target by 75% indicates that the market views Blue Owl as a primary beneficiary of the AI infrastructure supercycle. Unlike peers such as Apollo or KKR, which derive significant portions of their income from realized carry or insurance balance sheet spreads, Blue Owl is an FRE pure play. This makes the firm's earnings significantly more predictable and higher quality. The firm reported a 19% growth in FRE and a 16% increase in distributable earnings in 2025. The firm's AUM not yet paying fees stands at $28.4 billion, which represents an embedded revenue tailwind of $325 million to $361 million in annual management fees once deployed. This earnings layer cake provides a clear path to margin expansion and dividend growth without the need for volatile market exits. The establishment of an alternative credit strategy following the Atalaya acquisition represents a tactical evolution. Asset-based finance is increasingly seen as the next frontier for private credit, offering attractive risk-adjusted returns by lending against physical or financial assets rather than corporate cash flows. By targeting the $11 trillion ABF market, Blue Owl is insulating its credit platform from the potential compression of spreads in the highly competitive corporate direct lending space.
Company overview. Architectural foundations, the three pillars of Blue Owl. To understand the bull and bear cases for Blue Owl, one must analyze the mechanisms by which it generates value across its three primary platforms. The firm's differentiation lies not merely in what it manages, but in the structure of that management. Approximately 93% of Blue Owl's AUM is comprised of permanent capital, a figure that provides an unparalleled level of revenue visibility and insulates the firm from the fundraising treadmill that often forces asset managers into disadvantageous investment decisions. The credit segment is the firm's largest and most established vertical, managing $157.8 billion in AUM as of December 31, 2025. This platform functions as a sophisticated financing partner for private companies, primarily in the upper middle market. The platform's prowess is reflected in its gross originations, which have totaled $188 billion since inception. The primary vehicle for this segment, Blue Owl Capital Preparation, OBDC, maintains a portfolio of $16.5 billion to $17.1 billion across more than 230 companies. The credit platform strategy is heavily weighted toward technology and software, a choice that has historically provided high yields and low loss rates, but has recently become a focal point of market anxiety. Beyond traditional direct lending, the credit platform has expanded into alternative credit via the acquisition of Atalaya Capital Management, targeting an $11.2 trillion addressable market in asset-based finance. This expansion suggests a strategic intent to diversify away from pure corporate credit into areas where collateral provides an additional layer of protection.
The Real Assets platform has transitioned from a traditional net lease provider to a leading player in the digital infrastructure space, managing $80.6 billion in AUM. The cornerstone of this segment has been its net lease strategy, which owns over 6,025 properties and maintains relationships with more than 860 tenants. This strategy has been durable, with net lease flagship funds generating a net internal rate of return of 24% since inception. However, the most significant catalyst within this platform is the acquisition of IPI Partners in early 2025. This move established a dedicated digital infrastructure vertical, positioning Blue Owl to capitalize on the soaring demand for data centers driven by artificial intelligence adoption. The firm's Digital Infrastructure Fund 3 recently closed on $7 billion, reflecting massive investor appetite for this asset class. Blue Owl's competitive advantage here is operational. It employs a 950-person development and operating team to navigate the complex power and site selection challenges that define the modern data center market. The GP Strategic Capital platform is perhaps Blue Owl's most unique offering, managing $69.1 billion. This platform provides minority equity and debt financing to other alternative asset managers. By partnering with over 70 firms since inception, Blue Owl has created a layer cake of management fee revenue that is entirely independent of the underlying asset performance of those firms. This segment acts as an index for the growth of the broader alternative asset management industry, allowing Blue Owl to benefit from the secular shift toward private markets without taking the direct balance sheet risk associated with the specific investments of its partners.
A nuanced understanding of Blue Owl requires a direct comparison with its primary rivals, Blackstone, Apollo, and Ares. Each firm has a distinct strategic focus, but they all compete for the same institutional and retail allocations. Blackstone remains the industry's undisputed behemoth with over $1.1 trillion in AUM. While Blue Owl focuses on specific verticals like GP stakes and direct lending, Blackstone competes across every vertical. Blackstone's operating margin of 44.6% is the highest in the industry, and its return on equity (ROE) of 26.5% demonstrates best-in-class capital efficiency. Blue Owl, by comparison, is still in its scaling phase, with a lower net margin of 2.7% as of late 2025 and an ROE of 5.1%. However, analysts forecast Blue Owl's ROE could reach 47.1% within 3 years if its asset-light management model continues to scale. Apollo is Blue Owl's direct and intense rival in credit and insurance solutions. Through its acquisition of Athene, Apollo has secured a durable capital advantage that Blue Owl is attempting to replicate through its Kuvare acquisition and insurance solutions platform. Apollo trades at the cheapest valuation in the group, 19 times trailing earnings, largely due to the complexity of its insurance-heavy balance sheet. Blue Owl, by eschewing the large insurance balance sheet in favor of an FRE pure model, has historically commanded a higher multiple, but this premium is currently being challenged by market volatility. Ares is the most comparable firm to Blue Owl in terms of credit focus. Ares manages over $600 billion and holds a 12% market share in the global direct lending space. Ares has outperformed industry averages with a 20% year-over-year increase in FRE. In the short term, some analysts view Ares as a better buy due to its higher market cap, $33 billion, and higher annual EBITDA, $2.31 billion, versus Blue Owl's $780 million. Blue Owl, however, has less total debt than Ares, $3.78 billion versus $12.7 billion, which may provide it with greater flexibility during a credit downturn. Macroeconomic headwinds and the 2026 horizon. The performance of Blue Owl in 2026 will be dictated by several overarching macro forces, primarily the trajectory of interest rates, the health of the U.S. consumer, and the stability of global trade. The Federal Reserve is widely expected to pursue measured rate cuts in 2026. S&P Global Ratings economists expect 2 25 basis point cuts during the year. Historically, the S&P 500 PE multiple has risen by 5 to 10% during periods of non-recessionary rate cuts. For Blue Owl, rate cuts are a double-edged sword. They reduce the interest burden on its borrowers, lowering default risk, but they also lead to lower yields on its floating-rate debt investments, which comprised 97% of OBDC's portfolio in late 2025. Despite rising costs, consumer spending remains resilient, particularly among wealthier individuals and retiring baby boomers. This resilience supports the underlying businesses in Blue Owl's portfolio,
particularly those in the healthcare and logistics sectors managed by its real assets platform. The Social Security cost of living adjustments have surpassed wage growth, providing a significant boost to the economy and supporting the all-weather appeal of direct lending. The 2026 outlook is clouded by a high degree of unpredictability regarding trade policy and tariffs. S&P Global Ratings has warned that global economic uncertainty around trade and geopolitical tensions could create a hair-trigger environment for market crashes. For an asset manager like Blue Owl, which relies on the ability to raise capital globally, any breakdown in international financial cooperation could hamper its expansion into European and Asian markets.
Deployment of the fee holiday capital. The $28.4 billion in AUM not yet paying fees is the firm's most potent growth lever. This capital consists of unfunded commitments and undeployed debt that will automatically trigger management fees once invested. Management's ability to find attractive deployment opportunities in a volatile market will determine whether the firm can hit its 58.5% FRE margin target. Lowering the dividend payout ratio. One of the most frequent criticisms of Blue Owl has been its aggressive dividend policy. The 107%, 108% payout ratio in 2025 left the firm with little retained capital for growth. The announcement of a fixed annual dividend of 92 cents for 2026 represents a strategic shift toward lowering the payout ratio toward 85% over time. This move is essential for the firm's long-term financial health, even if it is viewed by some income-seeking investors as a sign of slowing growth. Conclusion: a bifurcated outlook. Blue Owl Capital Inc. represents a high-conviction bet on the industrialization of alternatives. The bull case is anchored in a structural reality. The world is moving toward private markets, and Blue Owl has built the most efficient mechanism for capturing the resulting fee income. Its leadership in digital infrastructure and its dominance in the private wealth channel provide it with secular growth drivers that its peers are still struggling to build. The bear case, however, is equally grounded in structural risks. The firm's concentration in technology lending and its reliance on semi-liquid retail vehicles create a vulnerability to a run-on-the-bank scenario if credit quality deteriorates. The early 2026 redemption surge in OTI and the software market scare serve as warnings that Blue Owl is not immune to the full credit cycle.